skipping even one part means you miss the diamonds. The real lessons are at the end. Watch all the way through if you're serious about winning. Every day, thousands of beginners in the UK open their first Forex accounts, filled with excitement, ambition, and hope. But sadly, most of them fail. Not because Forex is impossible, but because they start the wrong way. Today, I'm going to give you a step-by-step guide on how to start Forex trading in the UK the right way. If you're serious about building a long-term trading career and not just gambling your money away, this is where you begin. Step 1. Understand what Forex really is. When most people in the UK first hear about Forex trading, they picture fast money. They've seen flashy YouTube ads promising to turn 200 into 2 sarals in a week, or Instagram traders showing off designer watches, rented cars, and screenshots of 5-figure profits. These images create the illusion that Forex is a shortcut to wealth. And because of that, thousands of beginners rush to open their first account with almost no real understanding of what Forex actually is. That misunderstanding is the root cause of failure. Before you learn about brokers, leverage, or strategies, you must first build the right perspective. If you start with the wrong mindset, everything that follows will collapse. So, let's slow down and look at what Forex really is, beyond the hype, beyond the sales pitches, and beyond the myths. The Forex market, the world's largest marketplace. The word Forex comes from foreign exchange. It's the marketplace where one currency is traded for another. Every time you travel abroad and exchange pounds for euros or dollars, you've participated in Forex. But on a much larger scale, banks, hedge funds, corporations, and governments trade currencies daily to manage risks, facilitate international trade, and speculate for profit. The scale is mind-blowing. The Forex market processes over $6 trillion worth of transactions every single day, making it the largest financial market on the planet. To put that in perspective, it's bigger than the stock market, commodities market, and crypto market combined. And the British pound GBP consistently ranks among the top 4 most traded currencies in the world, alongside the US dollar, euro, and Japanese yen. This means that when you trade GBP pairs like GBP USD or EUR GBP, you're stepping into a battlefield with global giants, banks, institutions, and professional traders who've been in the game for decades. If you come unprepared, you're not playing a friendly game, you're putting yourself against professionals who eat beginners alive. Forex trading is a business, not a bet. Here's the first harsh truth. Forex is not gambling. Yet most beginners treat it like a casino. They throw money at trades without understanding the market, hoping to get lucky. But unlike roulette or slot machines, Forex trading rewards knowledge, discipline, and planning. Think of it like starting a business. If you were opening a coffee shop in London, you wouldn't just rent a building and expect people to flood in. You'd research suppliers, hire staff, manage expenses, and spend months building systems. You'd expect the first year to be tough, maybe even unprofitable. Forex is the same. You must treat it like a business, building structure, managing risk, and thinking long-term. The nature of currency movements. To truly understand Forex, you need to understand what moves currencies. Prices don't just move randomly. They are influenced by central banks, the Bank of England's interest rate decisions and statements, economic data, inflation, GDP, unemployment, and wage growth, global events, political stability, trade relationships, and even natural disasters. Market psychology, fear, and greed among traders can cause massive swings. When GBP USD rises, it's not just the pound is strong. It might mean the Bank of England is signaling future rate hikes while the US Federal Reserve is cutting rates. When EUR GBP falls, it may be because UK data came in stronger than Eurozone data. Understanding this teaches beginners that Forex is not about guessing. It's about analyzing probabilities based on both fundamentals and technicals. The myth of easy money. Most beginners enter Forex because they believe it's an easy way to make money. But let's be honest, if it were easy, everyone would be rich. The statistics don't lie. Between 70–80% of retail traders lose money in the long run. Why? Because they rush in with wrong expectations. They think a 500 can magically turn into $50 in a few months. They believe copying signals or buying a robot is enough. They don't realize Forex requires years of practice, emotional discipline, and deep understanding. The people who survive and thrive are the ones who reframe Forex not as a lottery ticket, but as a long-term skill. No different from learning law, medicine, or engineering. Building the right mindset from the start. So how should a UK beginner think about Forex? Here are the key mindset shifts. Focus on survival, not profit. Your first year is about learning, practicing, and protecting capital, not making big money. Accept that losses are part of the game. Even professional traders lose. The difference is they manage losses intelligently. Respect the process. You wouldn't expect to become a surgeon after watching a few YouTube videos. Don't expect to master Forex in a few weeks. Think in years, not weeks. The traders who succeed are the ones who stay consistent for years, not those who chase shortcuts. Why this step is critical in the UK context. UK traders have a unique advantage and challenge. On one hand, being in London, the world's largest Forex hub, means you're trading in the most active time zone with the highest liquidity. On the other hand, it also means you're competing against some of the sharpest institutional players in the market. If you approach Forex like a game, you'll get crushed. But if you respect it as a business, you'll start building the foundation that separates serious traders from gamblers. Common beginner mistakes at this step: believing in get rich quick Forex courses or Telegram signals, trading live before practicing on a demo account, ignoring how economic news impacts GBP pairs, comparing themselves to professional traders with 50,000 of accounts. Thinking Forex is about beating the market, instead of learning to survive within it. Conclusion of Step 1: Understanding what Forex really is lays the foundation for everything else. If you enter with false expectations, thinking it's quick money, you'll almost certainly blow your account. But if you approach it with respect, patience, and a business-like mindset, you'll give yourself a real chance to grow. Forex trading in the UK is not about instant profits. It's about long-term survival, disciplined learning, and gradually building consistency. And until you accept this reality, no strategy, broker, or indicator will save you. So, before you move to the next step, ingrain this into your mindset: Forex is a business, not a bet. Treat it like one, and you'll already be ahead of 80% of beginners who enter blind. Step 2: Choose an FCA-regulated broker. If Step 1 is about building the right mindset, Step 2 is about protecting yourself before you ever place a single trade. And that protection begins with one decision: choosing the right broker. This is where most UK beginners set themselves up for failure without even realizing it. Why the broker choice matters so much: think of a broker as your gateway to the Forex market. Every order you place, whether it's buying GBP USD or selling EUR GBP, goes through your broker. If that gateway is unreliable, shady, or unregulated, it doesn't matter how good your strategy is. Your money isn't safe. A bad broker can manipulate prices, delay withdrawals, offer unfair spreads, or, in the worst cases, disappear with your funds. Sadly, this happens all too often, especially with offshore brokers that aggressively target beginners with flashy ads promising high leverage and guaranteed profits. Beginners, blinded by greed, sign up, only to realize too late that they've handed their hard-earned money to a scam. That's why in the UK, your first rule of survival is this: only trade with an FCA-regulated broker. What does FCA-regulated mean? The Financial Conduct Authority, FCA, is the financial regulator in the UK. It enforces strict rules to ensure brokers treat traders fairly and keep their funds safe. When a broker is FCA-regulated, it means segregated client funds. Your money is kept separate from the broker's operational funds. If the broker goes bankrupt, your funds can't be used to pay their debts. Compensation Scheme. Under the Financial Services Compensation Scheme (FCS), your money is protected up to $85,000 if the broker collapses. Strict oversight. FCA-regulated brokers must follow transparent reporting and compliance standards. They can't just change prices to trick you. Leverage limits for protection. Retail traders in the UK are capped at 130 leverage to prevent reckless gambling. This rule, while frustrating to some, actually protects beginners from wiping out accounts in one trade. When you choose an FCA-regulated broker, you're essentially choosing security, accountability, and peace of mind. How to check if a broker is FCA-regulated? It's not enough for a broker to claim FCA regulation. You must verify it. Here's how: visit the FCA's official register online. Type in the broker's name or reference number. Confirm the broker is listed and authorized to deal with retail Forex clients. Double-check the broker's website matches the official company details. Scammers sometimes use fake, clone websites. If the broker isn't on the FCA register, don't risk it. No matter how good their spreads look or how convincing their marketing is, walk away. The danger of offshore brokers: many beginners in the UK get lured by offshore brokers based in places like Cyprus, Seychelles, Belize, or St. Vincent and the Grenadines. These brokers often advertise crazy leverage, 100, 500, 1,000, even unlimited. Huge bonuses on deposits, low or zero spreads. It sounds attractive, but here's the danger. Once your money leaves the UK and goes offshore, you lose protection. If something goes wrong, the FCA can't help you. You can't complain to the FCS, and good luck chasing your money in a foreign legal system. Offshore brokers know this, which is why they're so bold in making unrealistic promises. For a UK beginner who wants to build a real trading career, offshore brokers are a trap. They don't want your success, they want your deposits. What to look for in an FCA broker? Not all FCA brokers are equal. Even within the regulated space, you need to choose carefully. Here are the main factors to consider. Reputation and reviews. Look for brokers with a strong track record and positive reviews from UK traders. Don't just trust online ads. Dig deeper. Trading platform. The industry standard is MetaTrader 4's MT4 or MetaTrader 5's MT5. Make sure the broker offers stable user-friendly platforms. Spreads and fees. Choose a broker with competitive spreads. But remember, if it's too good to be true, it usually is. Deposit and withdrawal process. Test how easy it is to deposit and, more importantly, withdraw funds. A good broker processes withdrawals quickly. Customer support. You want 24/5 or even 24/7 support, ideally with UK-based service. Account types. Many brokers offer demo accounts, micro accounts, and standard accounts. As a beginner, start small. Don't jump into VIP accounts with big deposits. Common beginner mistakes. When choosing a broker: chasing high leverage. Beginners often pick brokers offering 100, 500 leverage, thinking it's a shortcut to profits. In reality, it's a shortcut to blowing the account. Falling for bonuses. Some brokers lure traders with 100% deposit bonuses. These usually come with impossible conditions, making it nearly impossible to withdraw your profits. Ignoring regulation. Beginners sometimes skip FCA brokers because offshore ones look cooler. But when problems arise, there's no protection. Trusting influencers. Many Instagram or YouTube mentors push specific brokers because they get paid commissions, not because the broker is good for you. The UK advantage. The good news for UK beginners is that the UK is one of the safest regions in the world for Forex trading. The FCA is one of the most respected regulators globally. Traders in other countries envy the protection UK traders have. By simply sticking to FCA brokers, you immediately reduce your risk of being scammed. That's a huge advantage. Don't waste it. Conclusion of Step 2. Choosing an FCA-regulated broker might not sound as exciting as talking about strategies, indicators, or profits, but it's one of the most important steps you'll ever take. Without a safe and regulated broker, everything else is meaningless. So here's the rule before you trade: protect yourself. Check the FCA register. Verify the broker's details. Avoid offshore scams. And remember, a broker isn't just a middleman, it's your partner in this business. Pick the wrong one, and your journey ends before it even begins. Pick the right one, and you'll have a secure foundation to build your trading career in the UK. Forex trading is already challenging. Don't make it harder by gambling with an unsafe broker. Choose wisely, and you'll thank yourself years down the line. Step 3. Learn the basics of trading. Once you've built the right mindset and chosen a safe FCA-regulated broker, your next step is education. And not the kind of education where you binge watch random YouTube videos for 2 nights and think you're ready. I mean a structured approach to learning the fundamentals of Forex trading. The truth is, most UK beginners blow their accounts not because they lack talent, but because they rush. They skip the basics. They want strategies before they even know what a pip is. That's like trying to run before you've learned how to walk. If you want to succeed, you must respect this stage. Why basics matter more than strategies? Think of trading like building a house. Strategies are the roof, but the basics are the foundation. If your foundation is weak, the roof collapses no matter how fancy it looks. A trader who understands the basics of Forex can adapt, survive, and grow. A trader who skips them is building on sand. Key concepts every UK beginner must learn. 1. Currency pairs. Forex is about trading one currency against another. In the UK, you'll deal a lot with pairs involving the British pound GBP. Examples: GBP USD, pound VSIS, US dollar EUR, GBP Euro, VS, pound GBP JPY, pound VSIS. Japanese yen. The first currency is called the base currency, and the second is the quote currency. If GBP USD is 1.2500, it means 1 equals 1 TD5. Understanding this is the first building block. 2. Pips. A pip is the smallest unit of movement in Forex pricing, usually the 4th decimal place. For example, if GBP USD moves from 1.2500 to 1.2505, that's a movement of 5 pips. Pips matter because they determine your profit or loss. Beginners who don't understand pips don't understand what they're risking. 3. Lots and position sizing. Forex trades are measured in lots. 1 standard lot 100,000 units of currency, 1 mini lot 10,000 units, 1 micro lot 1,000 units. As a beginner in the UK, you should start with micro lots. This way, even if the market moves against you, your losses stay small. Too many beginners dive into standard lots, and one bad trade wipes them out. 4. Leverage. In the UK, leverage for retail traders is capped at 1 in 30. That means with the 1,000 you can control 30,000 worth of currency. This can amplify profits, but it also amplifies losses. Beginners must understand leverage is not free money, it's a double-edged sword. Respect it, or it will destroy your account. 5. Spreads and commissions. Your broker makes money through spreads, the difference between the buy and sell price, or through commissions. If GBP USD has a 2-pip spread, and you enter instantly, you're already down 2 pips. That's the cost of doing business. Understanding spreads helps you calculate true costs. 6. Technical analysis. VES. Fundamental analysis. Technical analysis, studying charts, patterns, and indicators like moving averages or RSI. Fundamental analysis, studying economic news, like Bank of England decisions, inflation data, or GDP releases. A successful trader uses both. Technicals show when to enter. Fundamentals explain why the market is moving. Beginners in the UK often ignore fundamentals, but the pound GBP is one of the most news-sensitive currencies. If you skip fundamentals, you'll get blindsided. 7. Order types. There are different ways to place trades. Market orders: buy or sell instantly at the current price. Limit orders: enter at a specific price you set. Stop orders: trigger a trade when price hits a certain level. Stop loss orders: close your trade automatically at a loss level you define, protecting your account. Most beginners only use market orders, but serious traders know how to use all of them strategically. The importance of demo accounts. Before risking real money, UK beginners should always start on a demo account. This lets you practice with virtual money in real market conditions. You'll learn how to use the platform, place orders, calculate lot sizes, and manage trades, all without financial risk. Some beginners skip demo accounts because they think it's a waste of time. Big mistake. A demo account builds confidence and experience. It's where you make beginner errors without consequences. Think of it like a flight simulator for pilots. You wouldn't want a pilot learning on a real plane with passengers on board, right? Don't treat your money as the test flight. How long should you study the basics? This depends on your dedication. If you put in 1 hour and 2 hours a day, you can understand the fundamentals in a couple of months. But don't rush to go live. A good benchmark is this: only move to live trading once you can explain what a pip is. Calculate position size for any trade. Use stop losses without hesitation. Read an economic calendar and know when UK data releases are happening. Follow your demo account rules consistently for at least 3 months. Common beginner mistakes at this stage: jumping to strategies too soon. They want to learn the best setup before even knowing what leverage is. Overloading indicators. They crowd charts with 5-10 indicators, thinking more tools tell more accuracy. In reality, it just creates confusion. Ignoring news. Many beginners stare at charts without realizing GBP can swing 100 pips in seconds after a Bank of England announcement. Not practicing enough. They spend more time watching other people trade than practicing themselves. UK advantage in learning. As a UK beginner, you have access to some of the best resources globally. FCA-regulated brokers offering free demo accounts. Economic calendars from trusted UK financial websites. Active trading communities based in London, the world's Forex hub. Abundant educational material in English compared to non-English speakers. Take advantage of this. Don't waste it by rushing. Conclusion of Step 3. Learning the basics of Forex trading may feel boring compared to the excitement of placing live trades, but it's the stage that separates survivors from victims. The truth is, every blown account in the UK can be traced back to a lack of understanding in these fundamentals. Before you place your first live trade, make sure you can confidently explain pips, lots, leverage, spreads, and order types. Make sure you can read both charts and economic calendars. And above all, make sure you've practiced in a demo environment until trading feels second nature. Remember, knowledge is your armor. Without it, you're stepping onto the battlefield unarmed. With it, you give yourself the fighting chance that 80% of beginners never have. Step 4. Master risk management early. If there's one skill that separates UK traders who survive from those who blow up their accounts, it's risk management. You can have the best broker, the sharpest strategy, and the cleanest charts, but if you don't know how to manage risk, none of it matters. Risk management is not an accessory in trading. It's the core of survival. And here's the hard truth: most beginners skip this step. They're so obsessed with profits that they never stop to think about losses. They ask, how much can I make on this trade? When the better question is, how much can I afford to lose? That difference in mindset is everything. The purpose of risk management, the point of risk management, isn't to avoid losing trades. You will lose trades. Even the best traders in London lose 40–50% of the time. The point is to make sure no single loss, or even a string of losses, can wipe you out. Risk management is about survival. Because in Forex, if you survive long enough, probabilities eventually swing in your favor. The golden rule: risk 1–2% per trade. This is the first law of survival. Never risk more than 1–2% of your account on any single trade. If you have a 1,000 account, risk only 120 per trade. If you have a 5,000 account, risk the 50s 100. If you're starting with their 500, your risk should be just 5–10. Beginners hate this rule because it feels too small. They want to make big money fast, so they risk 10%, 20%, even 50% of their account in one shot. It only takes one bad trade to wipe them out. Professionals don't think like that. They play the long game. By risking small, they make sure their account can handle losing streaks without collapsing. Position sizing: the key to control risk management starts with calculating the right position size. This means adjusting your lot size based on your stop, loss distance, and your risk percentage. Example: you have a 1,000 in your account. You're risking 1% for 10. Your stop loss is 20 pips. That means each pip must be 50. So your position size will be 0.05 lots micro position. This calculation ensures you always know your maximum loss before you even place the trade. Beginners who skip this step are essentially gambling. They have no idea how much they're risking until it's too late. Stop loss. Your safety net. A stop loss isn't just a tool, it's your insurance policy. It protects you from catastrophic losses. Yet many beginners in the UK either trade without stop losses, hoping the market will come back, move their stop further away when price gets close, refusing to accept the loss. Both approaches are fatal. The market doesn't care about your feelings. Without a stop loss, a small loss can snowball into a blown account. Professionals know this. which is why every single trade they place is protected. Risk to reward ratio. Another cornerstone of risk management is the risk to reward ratio. This measures how much you stand to gain compared to how much you risk. A common target is 1c2, risk 10 to make a 20. If your strategy wins only 50% of the time, but your risk to reward is 1i2, you'll still be profitable. Beginners ignore this and often settle for 101 or worse, risking 50 to make fi20. Over time, this guarantees losses. Professionals design trades so that even a lower win rate can still lead to growth. The psychology of risk. One of the biggest benefits of proper risk management is psychological. If you know you're only risking 1% per trade, you can stay calm. You won't panic if the trade moves against you. You won't feel pressure to win back your losses immediately. But if you risk 20–30% of your account, every trade feels like life or death. That kind of pressure destroys rational decision-making. You start revenge trading, increasing lot sizes, and ignoring your plan. The account spirals down quickly. Risk management frees you from that emotional trap. UK context. Why risk management is essential. The UK market has some of the most volatile trading sessions in the world. GBP pairs can move 100 pips in seconds after a Bank of England decision or a surprise CPI release. Without risk management, you'll be wiped out before you even understand what happened. By controlling your risk, you can survive these storms. You don't need to predict every news event. You just need to make sure one shock doesn't destroy you. Common mistakes beginners make. All in trade easy, risking the whole account on one perfect setup. This is gambling, not trading. Over leveraging, using maximum lot size just because the broker allows it. No plan for losing streaks. Beginners don't think about what happens if they lose 5 trades in a row. Professionals do. Chasing losses, increasing risk after a loss, hoping to recover quickly. This leads to even bigger losses. Building risk management into your plan. Here's how to implement risk management step by step. Decide your risk per trade. 2%. Calculate position size before entering. Place a stop loss on every trade. Aim for at least 1–2 risk to reward. Set a daily or weekly loss limit. For example, if you lose 5% of your account in a week, stop trading and review. These rules aren't optional. They're survival tools. The long-term advantage. Think of trading like a marathon, not a sprint. If you risk small and manage trades properly, you might grow your account slowly at first. But that slow growth compounds. A trader who grows 5% a month consistently will double their account in less than 15 months. Compare that to the beginner who risks big, makes 50% in a month, then loses it all in the next 2 weeks. Who really wins? The consistent trader. Conclusion of Step 4. Mastering risk management early is the best investment you'll ever make as a UK trader. It's not glamorous, and it won't get you flashy Instagram screenshots. But it will keep you alive. And in Forex, survival is the name of the game. Remember, this profits are optional, but risk is guaranteed. You can't control how much you'll win, but you can always control how much you'll lose. That's the power of risk management. Ignore it, and you'll join the 80% who blow their accounts. Respect it, and you'll join the small group who actually last in this business. Step 5e. Create a trading plan. If risk management is your shield, then your trading plan is your sword. It's the tool that guides every decision you make in the Forex market. Without it, you're just swinging wildly in the dark, hoping for luck. And luck is not a strategy. The harsh truth is this: most UK beginners don't have a trading plan. They wake up, check the charts, and enter trades based on instinct, random YouTube strategies, or worse, signals from strangers in Telegram groups. They treat trading like gambling because they have no structure. And that lack of structure is why they fail. Why you need a trading plan. Imagine going on a road trip from London to Edinburgh with no GPS, no map, and no directions. You might get there eventually, but chances are you'll waste fuel, take wrong turns, and maybe never arrive. Trading without a plan is exactly the same. A trading plan gives you consistency. You make decisions based on rules, not emotions. Clarity, you know exactly when to enter and exit. Accountability, you can track what's working and what's not. Control, you don't get swept away by fear or greed. Professionals treat trading as a business, and every business runs on a plan. If you're trading without one, you're not a trader, you're a gambler. The core elements of a trading plan: 1. Your trading goals start with clear, realistic goals. Don't write, "I want to make 10 Zalos in this month." That's fantasy for a beginner. Instead, aim for goals like, "I want to stick to my plan for 30 days without breaking rules. I want to risk no more than 1% per trade for the next 3 months. I want to achieve 3-5% growth per month consistently." Goals should focus on discipline and consistency, not just profits. 2. Markets you'll trade. The Forex market offers dozens of pairs, but beginners in the UK should focus on a few major ones. GBP/USDZ, the most liquid and heavily traded pair. EUR/GBP, important for UK Eurozone dynamics. GBP/JPY, high volatility, but great for practice once you're experienced. Don't spread yourself too thin. Pick 2 to 3 pairs and master them. Each pair has its personality. GBP/USD reacts differently to news compared to GBP/JPY. 3. Time frames you'll trade. Decide if you'll be a scalper in and out within minutes. A high stress, not ideal for beginners. Day trader trades last a few hours, often closed by end of day. Swing trader, holding trades for days or weeks. Position trader, long-term, holding for months. For UK beginners, day trading or swing trading is often the most realistic. The London session offers excellent volatility, and you don't need to sit in front of charts all day. 4. Entry rules define exactly what needs to happen before you enter a trade. For example, only trade in the direction of the 4-hour trend. Enter only when price pulls back to the 50 EMA and shows a bullish candlestick. Never trade during high-impact news events like Bank of England rate decisions. The more specific your entry rules, the less likely you are to take impulsive trades. 5. Exit rules. Beginners often fail because they don't know when to exit. They close winners too early and let losers run too long. Your plan must include stop-loss rules, where to cut losses. Take profit rules, when to secure profits. Trailing stop rules if you want to ride longer moves. For example, always risk 30 pips for a chance at 60 pips. If trade moves 30 pips in my favor, move stop to break-even. 6. Risk management rules. We covered this in step 4, but it must be written in your plan. Spell out risk per trade: 1-2%, maximum daily loss (doji) 3%, maximum trades per day. This prevents you from blowing your account during emotional moments. 7. Trading schedule. When will you trade? The UK has an advantage because the London session at 8 am to 5 p.m. UK time is the most active session globally. Many beginners waste time trading random hours. Instead, choose specific windows. For example, I'll trade GBP/USD only between 8 am and 11 am, Monday, Thursday. This keeps you focused and avoids burnout. 8. Review process. A trading plan isn't static, it's alive. You must review and refine it. Keep a trading journal with screenshots, reasons for entry, emotions, and outcomes. At the end of each week, review your trades. Ask, did I follow my plan? Where did I break rules? What patterns keep repeating? This process builds self-awareness and discipline. Common mistakes beginners make with trading plans: they don't write it down. Having a plan in your head doesn't work. Write it down and commit. They overcomplicate it. Beginners load their plan with 20 rules. Keep it simple. Focus on 45 key rules you can actually follow. They abandon it after a few losses. A plan isn't a magic shield against losses. Losing trades will happen. The plan is there to protect your account and keep you consistent. They copy someone else's plan blindly. Your plan must fit your personality, schedule, and risk tolerance. Copying a scalper's plan when you have a 9-to-5 job will not work. UK focus. Why a plan matters more here? Because the UK market is so active, it's easy for beginners to get caught in noise. GBP pairs can spike on unexpected news, then reverse minutes later. Without a plan, you'll chase these moves and lose. With a plan, you'll know when to trade and when to sit on your hands. Sometimes the best trade is no trade. Conclusion of Step 5. Creating a trading plan is not optional, it's survival. It transforms you from a random gambler into a disciplined trader. It gives you rules, consistency, and clarity in a chaotic market. Here's the harsh truth: without a plan, you will fail. With a plan, you at least give yourself a fighting chance. And when you stick to it, refine it, and trust it, that's when you separate yourself from the 80% who blow their accounts. So write it down. Keep it simple. Follow it with discipline. And remember, your trading plan is your weapon. Don't step into the market without it. Step 60, start small, stay consistent. By now, you've built the right mindset, chosen an FCA-regulated broker, learned the basics, mastered risk management, and created a trading plan. But here's where many UK beginners make their biggest mistake. They try to sprint before they've even learned how to walk. They deposit too much, trade too big, and expect instant success. And within weeks, their accounts are gone. The truth is, Forex is not about how fast you grow. It's about how consistent you can be. That's why the next step is simple but critical. Start small and stay consistent. Why starting small matters. When you first go live, your goal is not to make money. It's to learn how trading feels with real emotions involved. Demo accounts are great for practicing mechanics, but they can't teach you the psychology of risking real pounds. The moment you trade with real money, even if it's just 50, your emotions change. Suddenly every pip matters, and you'll feel fear and greed in ways you never did in demo mode. Starting small allows you to experience those emotions without destroying your finances. If you blow a 4,200 account, it hurts, but it doesn't ruin your life. Blow a fee $5,000 account in your first month, and you may never recover mentally or financially. How small should you start? There's no universal number, but for UK beginners, here are realistic starting points. 100-500 account, perfect for testing your plan. Live while keeping risks minimal. 500 to 1,000 account, a comfortable range to build discipline while practicing consistency. Above $1,000 only once you've proven you can follow your plan and manage risk for at least 6-12 months. The key is this: size doesn't matter at the start. Discipline does. Even a FCA-200 account can teach you more about trading psychology than any book or video ever will. The power of consistency. Consistency is more important than profit. A trader who sticks to their plan, follows risk rules, and executes the same way every time will eventually grow. A trader who flips strategies every week, changes lot sizes randomly, and chases every signal will always lose. Consistency comes from trading the same pairs, trading the same time frames, following the same entry and exit rules, risking the same percentage per trade. This repetition builds habits, and habits are what turn beginners into professionals. Avoiding the get-rich-fast trap. In the UK, many beginners are lured by influencers showing huge profits. They think, if I just trade bigger, I'll get there faster. But the faster you try to go, the sooner you'll blow up. Think about it. If you grow a 500 account by 5% a month, that's for 25. It feels small. But if you can maintain that consistency, in a few years, compounding transforms that account into something significant. Meanwhile, the beginner who risks it all for 50% gains in a month loses everything by the second month. Which path is smarter? The slow one. The role of journaling in consistency. To stay consistent, you must track your trades. Keep a trading journal where you record date and time of the trade. Pair traded. Entry and exit. Risk and reward. Emotions felt. Whether you followed your plan. Reviewing this journal weekly will show you whether you're consistent. It will also expose bad habits you may not notice in the heat of trading. The psychology of staying small. Many beginners feel embarrassed trading small accounts. They compare themselves to others, thinking, what's the point of making FCA-10 this month? But here's the secret: the numbers don't matter. What matters is proving to yourself that you can be disciplined. If you can manage 500 with discipline, you can manage 50,000 with discipline. But if you can't control yourself with a small account, adding more money only multiplies your mistakes. Staying small forces humility and patience, the very qualities that protect you in this business. UK advantage. The London session. UK traders have a unique advantage. They're in the world's most active session. The London session overlaps with both Asia and New York, giving you excellent opportunities. But it also brings intense volatility. By starting small, you can learn how GBP pairs behave during these hours without taking catastrophic risks. For example, GBP/USD often spikes sharply around 80:30 at 9:30 am UK time when economic data is released. Beginners who go in with big lot sizes often get wiped out by these whipsaws. But if you're trading small, those same moves become valuable lessons instead of fatal losses. Common beginner mistakes at this step: depositing too much too soon. They put in more than they can afford, then panic when trades go wrong. Inconsistent lot sizes: one trade is 0.01 lots, the next is 0.7 lots with no logic behind it. Chasing losses: increasing risk after a losing streak, hoping to recover quickly. Comparing to others, feeling behind because someone else posted bigger profits. Quitting too early: they expect instant results and give up after a few months of small gains. Practical steps for UK beginners: fund your account with an amount you can afford to lose. Think of it as tuition. Commit to trading that account for at least 6 months without adding more money. Stick to your risk rules, even if the account feels too small. Journal every trade to track consistency. Focus on percentage growth, not pounds gained. The long-term view: consistency may not feel exciting in the short term, but it pays in the long term. A trader who compounds 5% a month for 3 years will multiply their account nearly 5 times. More importantly, they'll develop the discipline and habits needed to scale. By staying small now, you build the foundation to go big later. Conclusion of step 6: starting small and staying consistent is the opposite of what most UK beginners do. That's why most fail. They want quick wins instead of steady growth. But the truth is, steady growth is the only path that lasts. So, don't rush. Trade small. Focus on process, not profits. Build consistency like a muscle. And remember, every professional trader you admire once traded tiny accounts too. They didn't get there overnight. They got there by staying consistent, one trade at a time. Step 70: focus on the UK market fundamentals. Most beginners in the UK love staring at charts. They draw trend lines, stack indicators, and memorize candlestick patterns. Technical analysis feels simple because it's visual. But here's the harsh truth: if you ignore fundamentals, you're trading blind. And in the UK, ignoring fundamentals is even more dangerous because the British pound is one of the most news-driven currencies in the world. Why fundamentals matter: currencies don't move in isolation. They respond to economic health, central bank policies, and global events. A perfect technical setup on GBP/USD can be wiped out in seconds if unexpected inflation data comes out or if the Bank of England surprises the market. That's why successful traders don't just ask, "What do the charts say?" They ask, "What's driving this move?" In short, technicals tell you when to trade, but fundamentals tell you why the market is moving. The Bank of England, the biggest driver of GBP, the most powerful influence on the pound, is the Bank of England BOE. Every time the BOE meets to set interest rates, the Forex market braces for impact. Here's why: if the BOE raises rates, GBP strengthens. If the BOE cuts rates, GBP weakens. If the BOE holds rates but signals future changes, GBP reacts instantly. It's not just the rate itself, it's the tone of the Monetary Policy Committee (MPC). A 7-2 vote to raise rates is very different from a 5-4 split. Even the words of the governor during a press conference can spark massive volatility. Beginners who ignore these events often find their trades suddenly stop out during announcements, then wonder why the market turned against them. The truth is, the market didn't turn. It simply reacted to fundamentals they weren't watching. Key UK economic reports that move GBP. If you want to trade the pound, these are the reports you must track. CPI's a consumer price index inflation data. High inflation means the BOE may raise rates, strengthening GBP. Low inflation signals the opposite. GDP, gross domestic product, measures the health of the UK economy. Strong GDP boosts GBP, weak GDP drags it down. Unemployment and wage growth. If jobs and wages are strong, inflation risks rise, supporting GBP. Weak labor data often hurts GBP. Retail sales, a gauge of consumer spending, often a leading indicator of economic growth. PMI's, a purchasing managers index, tracks business activity. Numbers above 50 show growth, below 50 show contraction. These reports are released monthly, sometimes even weekly. Every trader in the UK should use an economic calendar to know exactly when they're coming. The role of global events: the pound isn't only shaped by UK data, it's influenced by global events too. For example, US Federal Reserve policy. Because GBP USD is the most traded pair, Fed rate changes impact the pound almost as much as BOE moves. European Union events: since Brexit, UK-EU trade tensions, negotiations, or crises can swing EUR GBP violently. Geopolitical shocks: wars, trade sanctions, or global instability often send traders running to safe haven currencies like USD JPY or CHF, weakening GBP. Ignoring these global spillovers means trading half blind in a global market. Why beginners avoid fundamentals? Many beginners avoid fundamentals because they seem complicated. Reading a central bank statement or interpreting an inflation report feels overwhelming. Charts, on the other hand, feel easier. They give instant feedback. But avoiding fundamentals is like trying to forecast weather by only looking out the window without checking the forecast. You might be fine for a while, but eventually, the storm hits you by surprise. How to blend fundamentals with technicals? The smartest traders don't choose between technicals and fundamentals. They use both. Here's how. Start with the calendar. Every Sunday, check the week's economic events. Highlight UK and US releases. Set expectations. If CPI is expected to rise, GBP may strengthen. If the market is expecting a BOE cut, GBP may weaken. Wait for technical confirmation. Don't trade purely on news expectations. Use charts to find entries that align with the bias. Example: if you know the BOE is likely to raise rates, you look for bullish setups on GBP USD. If charts align, you take the trade. If they don't, you wait. Practical example: a BOE rate decision. Imagine GBP USD is trending upward on the charts. You see a technical breakout forming. At the same time, you check the calendar and see the BOE is meeting tomorrow. Market expectations are for no rate change, but inflation has been climbing. There's a chance the BOE could hint at hikes. Instead of blindly entering today, you wait. If the BOE signals a hike and GBP spikes, you enter on the pullback with confidence, because fundamentals and technicals align. If the BOE surprises the other way, you avoid a losing trade altogether. That's the power of blending fundamentals with technicals. UK specific timing advantage: as a UK trader, you're in the best position to catch these moves. The London session opens just as major UK data is released. You don't need to wake up at 2 a.m. or stay up all night. By focusing on fundamentals during London hours, you can trade GBP pairs when volatility and opportunity are highest. Common beginner mistakes at this step: trading blind into news, entering a trade minutes before CPI or a BOE meeting without checking the calendar, overreacting to headlines, jumping into trades after the news without understanding the bigger context, ignoring global events, thinking only UK data matters, while GBP USD is equally affected by US Federal Reserve decisions. Analysis paralysis: beginners sometimes drown in too much data, making them freeze and miss trades. How to build a fundamental routine: daily check the economic calendar every morning. Weekly read summaries of BOE speeches, inflation outlooks, and UK financial news. Monthly, pay special attention to inflation, GDP, and labor data. These set the tone for GBP trends. Practice: even if you don't trade the news, watch how GBP reacts. This observation alone will sharpen your edge. Conclusion of Step 7: ignoring fundamentals is one of the fastest ways UK beginners blow accounts. The pound is not just a chart. It's a reflection of the UK economy, central bank policy, and global events. If you want to trade GBP seriously, you must respect these drivers. So, don't just be a chart reader. Be a trader who understands the why behind the moves. Blend fundamentals with technicals, prepare for economic events, and use your UK time zone advantage. Do this, and you'll separate yourself from the majority of beginners who get blindsided by news and wonder why the market feels unfair. The truth is, the market isn't unfair. It's just that most people aren't paying attention. Step 8: control your emotions. If there's one thing that destroys more UK trading accounts than bad brokers, poor risk management, or even ignoring fundamentals, it's emotions. Fear and greed have no respect for your education, your trading plan, or your strategy. If you don't learn to control them, they will take over, and once they do, your account balance won't last long. The truth is simple: trading is 20% skill and 80% psychology. Most beginners spend all their time learning indicators, but very little time learning how to control themselves. And that's why they fail. Why emotions are so dangerous in trading: when you put real money on the line, your brain reacts as if you're in danger. The fear of losing money activates the same fight or flight response you'd have if a lion were chasing you. Your heart races, your palms sweat, and your rational thinking shuts down. At the same time, when you win, your brain releases dopamine, the pleasure chemical. It makes you crave more wins, just like a gambler chasing the next jackpot. This is why beginners often spiral after wins and losses alike. Emotions override logic and discipline disappears. The two big enemies, fear and greed. Fear makes you hesitate when you should act. Fear makes you close trades too early, cutting profits short. Fear keeps you from taking the next setup because you're still haunted by the last loss. Fear creates paralysis and inconsistency. Greed makes you increase lot sizes after a win. Greed pushes you to trade when there's no valid setup. Greed convinces you to hold onto trades longer than your plan says, hoping for just a little more. Greed makes you reckless and blinds you to risk. Every blown account in the UK can be traced back to one of these two emotions. Revenge trading, the most dangerous emotional trap. One of the most destructive behaviors is revenge trading. Imagine this: you lose 50 on a trade. Instead of walking away, you feel angry. You want to get it back. So you jump into another trade without analysis. That loses too. Now you're down 150. Instead of stopping, you double your lot size to recover. Within hours, your account is gone. Revenge trading doesn't come from logic, it comes from ego. You're not trying to follow your plan. You're trying to prove the market wrong. But the market doesn't care about you. It will punish you harder the more emotional you get. Overconfidence after wins. The opposite side of revenge trading is overconfidence. A beginner has 2 or 3 good trades, maybe even doubles their account in a week. Suddenly, they feel unstoppable. They think, I've cracked the code. That's when they break every rule. They risk more, ignore stop losses, and overtrade. Then one big loss wipes out everything. In the UK, where GBP pairs are volatile, overconfidence is especially dangerous. A calm week can make you feel like a genius, but one unexpected Bank of England comment can humble you instantly. How to control your emotions, practical methods. Trade with money you can afford to lose. If losing your trading capital would hurt your life, you're trading too big. Fear takes over when you can't afford to lose. Start small so you can stay calm. Set daily and weekly limits. Decide in advances. If I lose 3% in a day, I stop. If I lose 5% in a week, I stop. These limits protect you from emotional spirals. Always use stop losses. Knowing your maximum loss before entering keeps fear under control. Without a stop loss, every pip against you feels like a knife twist. Journal your emotions. Write down not just your trades, but your feelings before and after. Over time, you'll notice patterns. Maybe you overtrade when you're tired, or you take risks after a win. Awareness is the first step to control. Detach from individual trades. Don't obsess over one trade. Think in terms of series. If your plan works 55% of the time, then any single trade doesn't matter. What matters is following the process. Take breaks. If emotions are running high, step away. Walk, exercise, meditate, anything to reset your mind. Professionals know when not to trade. Beginners keep forcing trades until they crash. The role of discipline. Emotional control comes down to discipline. Discipline means following your plan whether you feel like it or not. It means taking the stop loss without hesitation, even if you believe the market will turn. It means stopping for the day, even when you want to keep trading. Discipline is not about never feeling fear or greed. It's about not letting them dictate your actions. UK advantage, time zone, and routine. As a UK trader, you have the advantage of trading during the London session, the most liquid in the world. But this also means high volatility and frequent emotional triggers. By creating a routine, trading only specific hours, reviewing fundamentals before entry, you reduce randomness and, by extension, emotional stress. For example, instead of sitting at your screen all day, decide, I will only trade from 8 a.m. to 11 a.m. and only GBP USD. This structure keeps your emotions in check. Common mistakes beginners make with emotions: trading when tired or angry. Emotional states outside trading affect decisions inside trading. Overtrading, jumping into trade after trade because they feel restless. Ignoring the plan. Letting emotions overrule written rules. Comparing to others, feeling inadequate because someone else posted bigger profits. This leads to reckless trades. Long-term benefits of emotional control: when you control your emotions, your account grows slowly but steadily. More importantly, your confidence grows. Not the false confidence of overtrading, but real confidence in your ability to stick to the plan. You begin to see trading for what it is: a game of probabilities where consistency beats excitement. Conclusion of Step 8. In the end, controlling your emotions is the final step that ties everything together. You can have the right broker, the right knowledge, the right risk rules, and the right plan. But if you let fear or greed control you, you'll throw it all away. The market is designed to test you. It will tempt you with greed and scare you with fear. Most UK beginners fail because they can't pass this test. But if you learn discipline, if you stick to your rules no matter how you feel, you'll separate yourself from the majority who blow their accounts. Remember this: the greatest battle in Forex is not against the market, it's against yourself. Master your emotions, and you master trading. Fail to control them, and no strategy in the world can save you.